All right, well, good morning. My name is Chris Caparelli, and with me on stage is my colleague Amy Miller, our Associate Director of Private Equity. As is often the case when we are not on stage and we're back in the office, I've got a bunch of questions for Amy around the asset class, where it is today, what the outlook looks like, and maybe just to give you a little flavor of some of where those questions are coming from. I'm a field consultant here at Marquette. I'm lucky enough to work with a bunch of phenomenal organizations, but they really run across the entire spectrum of client type. One thing that they all really have in common is, for the most part, have private equity allocations, and it's usually a big topic of conversation in the course of our normal client meetings. Before we get started and I start grilling you with questions, I want to ask a few of the audience first, just to kind of get us all on the same page. And I think the first one I have for you, and this is using the same software that Greg had up before with the QR code. So the first one I've got for you is for those of you that do have private equity in your portfolios, regarding the current allocation versus the target, is that allocation above, below, or at the target?
Interesting. Okay.
Okay. Oh,
well, it keeps going.
All right.
So
well,
good,
I think
good 2/3 are at or below. So that's I think that's really in line with what the ILPA survey says. So ILPA stands for the Institutional Limited Partners Association. They're a trade and advocacy group for institutional investors such as yourself that are investing in the private markets. They did a survey earlier this year where they surveyed, they have, I think, over 3,000 members in their organization, and these are the results of those. So you can see where your answers compare to theirs.
Yeah, and I think that's pretty consistent with what I see across my client base. Have been sort of overweight that target allocation for some time, and have sort of been fighting down towards the target as public markets have been rising up. All right, next question. The next maybe 5 years for your portfolio, is that allocation likely to increase, decrease, or stay the same compared to where it is today?
Ooh.
Okay, looks like a lot of keeping your target the same. I'd say, again, that's pretty consistent with my experience, and it looks like that's also pretty consistent with the industry. Next question, return expectations. We obviously look to this asset class to be a return driver in portfolios. The last 15 years have been pretty kind to this asset class. The last few years, maybe not so much. What are your expectations for the next 5 years, sort of compared to history? Okay, looks like a lot of consistency there, aligned with historic expectations.
Yeah, we see about a third, and the respondents think that it's going to decrease, but the majority think it's going to stay the same, maybe improve ever so slightly. Those are the bulls down there. I'll probably be in that camp.
All right, and then last one. This one's multiple choice. Five choices. What is most concerning to you regarding your private equity allocation? What keeps you up at night in this asset class? Okay, looks like we've got a winner there, which is a perfect segue, because that's exactly where I wanted to start, and really talk a little bit about the liquidity environment and maybe the lack of some of that liquidity. As I think about my client portfolios, they really need liquidity from their private equity allocation for a couple reasons. One, as we saw in the survey data, most are going to keep their allocations consistent, so they need that distribution liquidity to help them cover future capital calls in the asset class. Most of them are also cash flow negative to some degree, and they need liquidity from that asset class to help pay benefits or meet expenses just at that overall portfolio level. So the last few years have been a lot of talk about a lack of liquidity in this marketplace, sort of a stalled M&A environment that's leading to that. What are we seeing in the first half of 2025 as it relates to liquidity?
Let's go back a little bit further, Chris. We're going to look at this chart and see the last 25 years of distributions as a percent of the net asset value of the private markets portfolio. 25-year average is 21%. You can look at the last 3 data points here, and they're well below target. And so a pessimist will tell you that, maybe times are not that great right now, and they would probably be right, relative to what the 25-year average is. But What an optimist is going to tell you is that we're going to look at the 2022 numbers were 11%, 2023 was 10%, and 2024 was 12%. So an optimist is going to say, well, that's a 20% increase. So we think things are going in the right direction. And I'm going to fall somewhere in the middle. What I'm really looking for when we're trying to look at this and see whether or not there's some trends that we can point to give guidance to our clients is, what are the numbers going to tell us? And so if you look at the first half of 2025 in terms of the exit environment, volume was up 18.3% relative to the same period last year, but deal value was nearly 105%. So big deals are getting done. You look further back, the same period in 2023 relative to 2024, volume was almost flat, down slightly by 6.8%, but value was up 13% as well. So we did see some consistency there in terms of value. If you look at this chart here, there's 3 periods of significantly below the average. That is the post-tech bubble burst, post-GFC, and post what I'm calling the great rate hike of 2022. Anecdotally, and given the conversations that the team has been having with our GPs, we're seeing positive momentum, not just in sentiment, but also in deal flow, pipeline build out for a lot of the GPs that we've been backing. I think in short, though, what has happened is this domino effect of deal volume is down, which is creating exit volume is down, which is creating an environment where fundraising is down as well.
All right, so building out on that a little bit, I mean, if you look at that chart, certainly there's some optimistic data points in the very short-term time frame here, but the last kind of 10 and 15-year trend has not been great on the exit side of the equation.
Sure.
Talk a little bit more about that entry side of the equation, fundraising, and what we're seeing in the fundraising market.
Yeah. So I think, generally speaking, competition for dollars is really high. In the past year, there have been a lot of large investors, large LPs that have stated publicly that they intend to cut down the number of GP relationships that they have. The impact that is having on the market is more dollars are flowing to larger funds, so the above $5 billion funds. And then when you look at the past 10 years here, the average fund size in the US PE market has increased by over 2.3 times. So the funds are getting bigger. The story's yet to be written for 2025, but back to my comments about pattern recognition. If you look over the last 10 years, anywhere between a third and a half of the capital that's raised in any given year will flow into these funds that are above $5 billion. However, in the first half of 2025, that number's closer to 61%. So we're seeing the big funds getting bigger. Furthermore, though, I think another byproduct of this is that the time to raise a fund has increased significantly too. In 2024, that was 18 months relative to the 10-year average of 12 months. It's the highest level since 2010, which was nearly 20 months to raise a fund. Again, back to my comment, the big funds are getting bigger. It's taking markedly longer to raise them. Early indicators are showing that this is about to shift, as we've read a couple of articles recently that some LPs are kind of going back to the lower end of the middle market, which has tended to be our bias all along.
All right, so there's still plenty of activity in this space, still plenty of fundraising happening. And I think, I kind of draw that back to one of those earlier questions about institutional clients. So we look at our client base, for the most part, not really plowing a lot more capital in the space, keeping those allocations pretty consistent. So if the big funds are getting bigger, I think the next question is, well, where is this capital coming from? One answer that I have in my head is maybe looking for new LPs, specifically a lot of the buzz you're hearing in the press about expanding into the retail and the retirement channel. New regulatory changes have sort of opened the doors for that to happen at volume. How do you feel about that? It's a new pool of capital, new entrant in the market, and it's a new entrant in a market that's really historically been institutional only.
Yeah, I mean, there are some concerns. It's still early innings, but the growth in this segment has been extremely swift. In 2022, there were 23 what we'll call interval funds, and just to make the distinction, this is different than your institutional grade evergreen funds, which we see a lot of our clients going into in terms of their infrastructure or their private credit exposure. So that's a different vehicle. But it was 23 funds in 2022. It's trending towards 63 funds in 2025. That's almost a 3x uptick in the funds that are coming under registration or who have already been registered. I think some important notes on these vehicles, though, is that the clarity on investment strategy, infrastructure, liquidity terms, and particularly fee transparency, there's a lot left to be desired here that still needs some rewiring. I was at a presentation back in June where there was an individual that was presenting his firm's what we'll call an interval fund for the RIA channel and the retirement channel, talking through how great this fund is. And so I was the nerd in the front, raising my hand, asking all the questions towards the end of their talk. What's the fee structure of this particular fund? Because the underlying managers, their fees tend to be 1.5% to 2%. So there's going to be a second layer of fees there. After multiple questions and drilling of this individual, as it turns out, this fee structure is going to end up being somewhere around 3%, and that's on top of those underlying manager fees. In addition to that, questions around portfolio construction. This wasn't just a private equity fund. It's got private equity, private debt, infrastructure, and real estate. Each of these 4 sub-asset classes have markedly different return expectations, and not only on the IRR side, but on the multiple side. And then there was a mention of a guarantee of a certain level of liquidity for this product. So of course my hand shot up right away. How are you going to guarantee that liquidity? And as it turns out, this portfolio was going to hold up to 7% in cash. So these 3 aspects are really something that investors need to be mindful of when they're setting the expectation for the return of this particular fund. I think regulators continue to work behind the scenes. What I would like to see, even though I don't like regulation for regulation's sake, is maybe some metrics or some restrictions around when an investor can get their money out, the lead time that they have to give the manager, just so that the manager knows. And there has to be an out for these clients, especially if they're going to be investing in their retirement accounts. We need fee transparency, 100%. We need portfolio construction transparency. And this is an area that I don't see there being any stutter in growth. And what that's going to create is more capital is going to flow into the asset class, which is going to support elevated valuations.
All right, well, let's hope we get some smart regulations to help protect that new class of limited partners. On the topic of valuations, we talked about it a fair amount today across asset classes. It seems like there's elevated valuations really everywhere you look, and private equity is probably no exception to that rule. Over the last couple of years, we've had a ton of market turmoil. We had the rapidly rising interest rates. We had supply chain dislocations, plenty of geopolitical concerns to be worried about. Given some of the volatility we've seen in the public markets, should we have expected to see a bigger correction in valuations on the private side?
Maybe. Is that an okay answer?
Sure.
What you just talked about is the downward pressure on valuations, and that uncertainty that's been going on in the market can certainly lead to depressed valuations. But what I want to kind of talk about with the group today is what's supporting these elevated valuations. Average over the last 10 years in this chart is 11.6 times. Last year was 13 times even. First half of this year, it's around 12.8. So there really hasn't been any degradation of valuations, even just given with what's going on with tariffs. But since 2015, over $3 trillion have been raised for U.S. private equity alone. A-plus assets continue to trade. So even though volumes are down, the really good companies are still continuing to trade. And what I mean by that is they've got professional management teams, strong free cash flow, they've got a sticky customer base, they're either selling mission-critical products or services, and they tend to be more recession resilient. It's also important to note that the multiples on this page are an aggregate across all industries, and not all industries are created equal. A lot of the trades that we've seen recently are in the high growth industries such as technology, healthcare, B2B services, and those tend to trade at higher multiples. One anecdotal note, I was looking up, doing a little bit of last minute preparation for today. There was an asset that was traded in the first half of this year. It was an electronic health records business that utilized AI. It traded for 27 times EBITDA, and it was acquired by a private equity fund. So I'd be curious as to what kind of debt package this particular company got, but this is just an example of how that 13x, that's an average. There's going to be a lot lower. There's going to be significantly higher too, depending on the industry.
So yeah, it sounds like it depends on the underlying fund, the sector that it's in, and even at the company level. Maybe one factor that has been a little bit more consistent across the entire industry, and really across everything in the portfolio, was rising interest rates. We felt the impact of that acutely in the public markets throughout 2022, and it affected, again, all corners of the portfolio. How has it impacted the private equity market specifically?
Yeah, I think one key impact has been on how much a transaction gets financed with either debt or equity. On this chart that we're showing, the green line shows debt as a percent of the capital structure. On the left axis, the blue is the effective funds rate on the right-hand axis. And there is obviously an inverse relationship between the two and the magnitude of debt that a portfolio company is financed with. But you'll see like the dip in the debt as a percent of the cap structure did happen after interest rates spiked in 2022. It went from 54% to 49%. Then as the debt as a percent drops, equity rises, which is a really expensive way to finance a deal. And so return expectations might be a little bit dampened if that were to continue. But as the interest rates have been cut in most recently last week, but more importantly earlier this year, debt as a percent of the cap structure has gone back up to 54%, even though it's still at an elevated interest rate. And what this tells me is that GPs have settled into the normal, that it's not zero interest rates. Deals still need to get done, and we are seeing that in terms of trends towards volume. I expect what we could see here is an increase in recapitalizations as interest rates continue to get cut. What we're also seeing anecdotally, though, is that GPs are being really cautious about this because there's still some uncertainty around how tariffs are going to impact the long-term profitability of the businesses.
So that's that kind of big piece of uncertainty out there left, right? I mean, we had a little bit of certainty into the market given the interest rate environment. Obviously, rates went up. They stayed stable for a while. We've got a little bit of a clearer picture as to where we think that's going to go going forward. But that doesn't seem to be the case in the tariff market. That's a shifting target and is likely to continue to be an impact going forward. So how do we think about this in the context of private equity?
Yeah, so we were able to get some data from Neuberger Berman, and this is a result of a survey that another survey that they sent out to the GPs that they've invested with. There were about 300 respondents, and as you can see, the results vary pretty significantly by industry, from little to no impact on the financial services side to a moderate impact further down the line within technology and business services. We've called out the 5 on the left because they are the 5 what we'll call major food groups that private equity targets. We added in consumer because that's number 6, and that's really a high topic of conversation because of the impact of tariffs are really trickling down to the consumer and thus impacting that industry as well. Think about the key attributes of these industries. They're large, they're fragmented, they're growing, and in the case of some, particularly healthcare, they're complex and highly regulated. It's important to note, though, that before all the tariff noise happened, we had COVID and the impact of COVID on the supply chain disruption and other geopolitical occurrences that were impacting that. So we had a lot of GPs were looking to their portfolio companies to diversify their supply chain, really to mitigate that risk going forward. And in that process, one of the other things that they did, which is serving them really quite well now, is to diversify their customer base as well. Why this is important is that most of the companies have said that they're going to pass those costs on to customers, and they don't want that customer concentration, whereas if they have a significant portion of their revenue reliant upon one single customer or one single customer type, that can really have an adverse impact. With this, you're looking at the consumer confidence index, the business confidence index, and it's a little bit below average, I think more so on the consumer, and this is really going to impact their spend on durables as well as the business's spend on investment in their company themselves. The delay in tariffs on certain Chinese imports, I think that's been delayed to, I think it's November was the last I read, was received positively by the market, but it is extending that uncertainty a little bit further out. I will land on a positive note, though. We do have a very optimistic outlook on the asset class. One of the things that we say internally and believe in wholeheartedly is that one of the key components of portfolio construction is really manager selection. So we remain cautious, and it's going to be dependent. All these impacts are really dependent on a manager by manager basis. So as long as we keep doing, our diligence and being selective, I think the last 2-year run rate is we're picking 1.1% of the managers we meet with to recommend to you, our clients. So we remain optimistic.
All right, well, thanks, Amy. I've got 15 more questions for you. I'll save those for back in the office offline. But thank you again for the insight. Really appreciate it. That's the end of our panel. Next up is Dave Hernandez talking about U.S. exceptionalism.